Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Hello and welcome to Live Squawk's Market Talk. This is our look back at the week gone, and I'll be doing that with two esteemed guests today. Mike Brown, Senior Strategist at Pepperstone, and Ryan Littlestone, Trader Analyst at Forex Analytics. Before we get into today's subject matter and the past week, just a quick disclaimer as usual. The content provided on this channel is for informational and educational purposes only. We are not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. With that, all legal stuff has been done, and we can get into the subject matter at hand. Well, subject matters at hand at the moment. So welcome, guys. Welcome to the weekly review.
Afternoon, mate.
Very good afternoon, mate. Esteemed guests. I feel like we've got a lot to live up to now.
Yeah, it's better than what I was going to call you.
You said it was a family show.
Yes, I did, and this is why I didn't say what I was going to call you. Right, just again, this is really just one of those quick reviews that put us through. That just takes us through what's happened over the course of the week and the financial market moves. Okay, I'm joined, as I said, by my esteemed guests, and we're going to go through today's, this week's stories, really, that have moved oil markets up around 8 or 9%, and sent equity markets south, really. So we'll start with that. We'll start with Mike. Mike, if you want to take the lead with this, what are your views? What is it you've seen in the markets, really, on this front?
Yeah, I mean, as you say, it's very, very much the sort of predictable market reaction to that, really, and we see that continuing to pan out now with a haven demand into gold, oil moving higher as on the back of the higher geopolitical risk premium, equities trading in the red pretty much everywhere, and the dollar finding some demand as well. I think probably the two most interesting takeaways from it for me, and obviously it remains an incredibly fluid situation as we sit here now. There's headlines coming in around another attack potentially. I think the two big takeaways for me are firstly that the dollar has found some demand for all the talk of the dollar not being a haven and no one liking America at this moment in time. When sort of push comes to shove, it's the dollar that everyone has flocked to as a safe haven. And I think the second interesting part of the reaction for me is what we've seen in fixed income. Treasuries were initially firmer, but actually treasuries, gilts, bunds, all DM govies are actually trading a little bit softer on the day now, which just I find interesting. You could argue there's a focus on potentially the inflationary implications of this rise in crude prices, but nonetheless, I find it interesting that everywhere else is sort of screaming risk off, haven bid, and the bond market just isn't really joining in with that.
Yeah, I mean, that's one thing I have seen. We were up at 4.37% and above for US 10-year yields at one point. Now they've come back a bit since then, but I think you're right. I think after that initial move, they've been very kind of moribund bond markets and bond action, and maybe, like you say, the prevailing thought is of more of an inflationary one as opposed to anything else. It's also interesting that OPEC have said, they've come out in the last few minutes and said that they don't plan to make any extraordinary measures around the situation, and rebuked, I think, IEA Birrell's inflammatory comments and panicky comments around the situation as it is at the moment. Ryan, from your perspective, I mean, you're more FX focused, I think, but so what are your views on what we've seen so far out of the Middle East?
Yeah, the usual suspects have obviously moved: oil, gold, the usual risk-off plays. I think what's been decisive is that the dollar's found this bid. Usually you'll see a run into the yen, a run into the Swissy, but everyone's gone running back to the dollar. Much the same as we saw, some months ago when we had Israel and Hezbollah and Iran lobbing stuff at each other. I think other markets like FX, like bonds, as you mentioned, are probably looking through this and thinking, yeah, well, we've been here before. It's going to kick off for a bit and then it will die down. I don't. It just feels a little bit different this time.
Well, it's been said as much. Israel said, "Look, this is going to take a little while. We're not finished yet." So sorry, let's cut across.
No, exactly. But they've also said in the run-up to this, they're not going to wait for the US to give them a green light. If they feel like they need to do it, they're going to do it. So whereas the Hezbollah thing, 6 or 8 months ago, everyone was on board. Even Rubio was out last night saying, we're not expecting anything. We don't know what they're going to do anything. And then Trump sort of backpedaling today on that. Of course, people who know what they're up to. But yeah, I think maybe the markets are trading a little bit complacent in terms of the increase in risk we might see over the weekend. But, touch wood, we hope that we don't see any escalation. And this is just another quick storm in a teacup and things calm down again.
Well, to go against Michael, I saw one of your posts earlier about everyone becomes a geopolitical expert, and I'm about to prove the case in point. From what I've read and what I've seen here, like you say, this might be a little bit different. Israel's taking it to its enemies at the moment, as we've seen in a number of situations. And with the Hezbollah thing, I find interesting because I think Israel's earlier attacks on them has decimated what they could possibly do anyway. So it's a bit of a moot point about whether they're coming to the party or not to sort of back Iran. They haven't got the resources to do so anyway, from what I've read. And like you say, going into a Friday, this puts the emphasis on maybe a bit of a safety play, really, as you would expect going into a weekend. So there may be some of those dynamics that play out later in the session as well. But yeah, it does feel a bit muted at the moment, and we're not really seeing the full effect. Maybe when the cash market opens, so one to watch on that front. But again, this is the all-prevailing sort of story of the weekend. But there are other stories that we had at the weekend, this week rather. One being the US inflation picture, and obviously that's going to be tinged by what we've seen today as well. Mike, what did you make of the US CPI report? And the likely Fed response to that?
Yeah, I mean, I thought it was pretty much as cool and as benign a CPI report as you could wish for. There's really nothing to dislike about it, whether you're looking at the month-on-month numbers, 0.1% on the headline and on the core, whether you're looking at the headline year-on-year at 2.4, barely moved from where we were in April, and the core number unchanged at 2.8. So a really, really solid set of data. I think the issue with it is we can't get too excited, and the Fed certainly won't be wanting to get too excited, because we all know that at some point the effect of tariffs pushing consumer prices higher is going to show up in the data. So I think it's very much a case of going, okay, well, May inflation was not as much of an issue as we thought, but we still know that CPI is going to rise on account of those tariff-induced price pressures. And, does that then show up in June? So I don't think it's a massive game changer of any sort for the FOMC. And Powell and co are just going to sort of try and stay on the sidelines as much as they can next Wednesday.
Are you surprised we haven't seen more of an effect from the tariff situation show itself? Yet?
Yeah, yes and no. I mean, simplistically, you would say it's a month after the tariffs were put in place. It should have shown up by now. But then, if you consider, we've all spoken at length about this idea of tariff front running, where businesses have effectively had a surge of imports in Q1, and they're probably still selling down stock that is in their inventories. So they probably don't actually need to pass the tariff costs on just yet. So maybe there's a sort of 2 or 3 month lag between the tariffs actually being imposed, that 3 month period where inventories are drawn down, and then you start to see it filtering into the price data a bit more.
That's a very good point. Just to counter that as well on this, the tariff threat, you've got the domestic issues as well. We saw from the super core index, which strips out for goods, food, energy, and housing, that was up 0.06%. That was down from 0.209 the previous month. Annually, it increased by 2.862 in May compared to 2.743. And as analysts at JP Morgan noted, a key contributor to the softer pace for core services inflation was a further cooling in the shelter prices as owners' equivalent rent rose 0.27%, while tenants' rent increased by 0.21%. So there were probably some domestic features just feeding into the number as well, which may counter some of that tariff stuff. But as you said, we've still got a couple of months maybe to see the effects of the trade war. Ryan, from a trading perspective, have you any sort of input on that?
Yeah, I mean, this CPI data, it has the market chasing its tail a bit, because we know CPI has been coming down, pushing the Fed closer to getting back on the cuts. You know, headline CPI is under 3%, the core's under 3%, we've been sailing above for 4 years. So that it's coming down, but then we got all this trade stuff, and then the market starts thinking more short term. Well, we're probably going to see an inflation boost coming in, which we haven't seen yet. So then the market's pricing cuts, then expecting higher inflation, which means we probably won't get cuts, and then we get a softer number, and then they go back to pricing cuts again. So for me, I concentrate purely on the year-on-year numbers, and CPI went up in the headline number to 2.4 from 2.3, and the core stayed unchanged. So as far as this report goes, it was a sticky one, but the market at the moment is happy to hit the dollar on anything that's bad news or that pushes the Fed towards cuts. I mean, you've got to look at jobless claims, the reaction we're getting. You know, we've been in a range, 220, 250 for, 2-3 years now. And we go from whatever it was, 242 to 248, and the market starts selling dollars, and that's the mood it's in at the moment. So any negative data at the moment is seeing the dollar get hit. Whether it's lasts for 5 minutes or 10 is another question. But I don't think that mood is changing just yet. So going back to the Iran stuff, if this calms down, I think markets will quickly switch back to trading what it was before this all kicked off.
Okay, fair play. Next subject is UK based. I know you two are going to love this.
Oh, do we have
Now, we can start with Karen, or we can start with the UK GDP figures from yesterday. I think we go with the GDP figures because it sort of counteracts Rachel Reeves's assertion that growth will help dig them out.
That lasted less than 24 hours that we're the country in the G7.
Data will always punch you in the guts. That's the thing. You can come out and say whatever you like, and then the data comes out and tells you otherwise. So yesterday, UK GDP shrunk in April by more than expected. It fell by 0.3%, 0.2 of a percentage point below economists' forecasts, and reversed the previous month's 0.2% expansion rate. It was led by services and manufacturing, with outputs of the former down 0.4% on the month, a steeper drop than the 0.1% forecast. So again, we'll start with Michael on this one. GDP, were we paying forward at the start of the year, and we're now getting payback for that in this April read?
In short, yes. I mean, I would caveat that by saying that the monthly GDP data is incredibly volatile, and when you couple that with the usual caveats that surround the general shambles that the ONS has become, I don't think there's much signal in the data. But yeah, you're absolutely right in terms of saying that what we saw in Q1 was a surge in exports as everyone tried to get ahead of tariffs, a big increase in activity in the property market as people tried to get ahead of the changes to stamp duty, also front loading of activity around the national insurance increase, car purchases, all these various factors that basically turned on their head at the start of April. So yeah, we are now starting to pay that back. Exports to the US actually notched their biggest decline on record in the month of April, which gives you an idea of how much of an impact the tariff front running was playing. Right. But fundamentally, it doesn't change the broader story, which is one where the UK economy is suffering with, at best, very anemic economic growth. Risks are clearly still tilted to the downside, and we're 3 or 4 months away from the budget in the autumn, where it seems inevitable that the Chancellor is going to have to stand there and raise taxes yet again to try and meet her fiscal rules.
Not great. Ryan, any views?
A little bit of Friday cheer for you, I know.
Yeah, thanks, mate.
And Ryan.
Yeah, thanks for leading into that one.
Yeah.
Much obliged. Not much to add. I think we are seeing a bit of this, and Bank of Canada's Macklem said it the other week as well. They got strong Q1 numbers, and they expect that to dip back in Q2. I think a lot of countries are going to be in the same boat. It is going to be interesting to see whether the UK is going to weather the storm a bit better. We're top of the queue almost for a trade deal with the US. Not that it probably means much in pounds and pence terms, but then we had Nvidia saying they're going to invest. So there's some small morsels of positivity that might creep back into the UK if obviously the government doesn't mess it up. And if that's the case, trading wise, we might see the pound regaining its sort of least dirty shirt mantra or label. So we might find the pound getting a bit more supported. Not that you'd note it this week after that horrendous data. And on the flip side, if we keep getting jobs numbers like that, then there's going to be trouble coming, and the Bank of England are going to be forced, I think, to get on the cutting wagon again, as they may do next week.
Well, it's a good segue into the Bank of England and to next week's events, really. Obviously, we have FOMC. We also have Bank of England next week. And I've got a note here from JP Morgan that says BOE, in their opinion, are to hold next week in a split vote with a dovish dissent, sticking with a gradual statement guidance. A large April inflation surprise warrants caution, but a weakening labour market suggests the committee will be comfortable signalling in an August cut. Again, are you two aligned with potentially August, or as you inferred, Ryan, you think there's potential into next week's meeting that they might go early?
I don't think they might go next week. You can never rule it out from these guys anyway. But I think they might err on the more dovish side. We get the CPI data out next week before the Bank of England. So if people are trading the pound, if that moves, if there's a big variation there one way or the other, it's going to, probably move the quid in last minute rate expectation trades.
Sure.
Is there any reason for them to be non-dovish? At the moment, no. So how long they can stay in this neutral mode, shall we say, it remains to be seen. So the risk is that they could potentially pull a cut out the bag. I'm surprised we haven't heard from Dingra now calling for a 75 pip cut or something silly like that, given that jobs data. So you can never rule out the risk of them pulling a cut next week, but otherwise they could stay on hold, I think.
Okay, fair enough. Mike, you got any views on the FOMC?
The FOMC or the BOE?
Sorry, the BOE. Your views on BOE first.
Keeping me on my toes there, mate, aren't you?
Someone's got to.
Well, yeah, exactly. It's been a long week and all that. I think there's absolutely no doubt in my mind, to be honest, that the BOE will hold bank rates steady at 4.25% next week. I think we'll probably have at least two dovish dissenters, probably Dingra and Taylor, maybe joined by a third, given that dismal labour market data that we had last week, or this week, I should say. But frankly, the bank's sort of overall approach is just to sort of try and bury their heads in the sand and hope that all these issues go away on their own, which isn't going to happen. And no matter how much they say in their statement that we'll ease in a gradual and careful manner, I think that guidance is probably on borrowed time. So they're not going to cut again until August. But by that point, I do worry how far they're going to be behind the curve.
Yeah, I think that, many are looking for the language or the statement language of gradual and careful easing to stay for this one last time, and then potentially there'll be some sort of change to that, as you say, because we're looking at quarterly cuts at the moment. And JP Morgan definitely go with that as well. I did jump into the Fed. I think we should go there next quickly, just very briefly. And Mike, I'll let you go with this one then. The Fed, unchanged next week as well, but obviously they're in their blackout period now, and obviously down to the data that we've had out as well.
Yeah, to be honest, no. I think the Fed are going to be staying firmly on the sidelines for the time being. They're really in the same boat as everyone else, with this huge degree of uncertainty, and as we were just discussing, the knowledge that we are going to see tariffs begin to show up in an uptick inflation at some stage. They're not really going to want to rock the boat especially much, and I think the policy statement will be sort of broadly unchanged. They are going to have to give us their latest summary of economic projections and the dot plot, which I imagine in an ideal world Powell would not want to have to be giving at this point. And I wouldn't place much weight on the forecast given how rapidly things are shifting around. But you'd expect growth to be nudged a bit lower, inflation to be nudged a bit higher in the short term. I think probably the most interesting thing is whether the dots again point to a median expectation that there's going to be 50 basis points of cuts this year. Obviously, that is bang on where the market is if you look at Fed fund futures right now, but it's relatively finely balanced. I think I was working it out earlier in the week. It only take two policymakers who are currently at that median to nudge their expectations 25 basis points higher, and it would move the median by that amount as well. So that's probably the underpriced risk around the FOMC. Other than that, it's going to be very much a case of saying as little as possible and leaving as much policy flexibility as they possibly can.
Yeah, just looking at a Danske note here, they say we still expect the Fed to cut rates twice in 2025, in line with March dots, followed by 3 more cuts in 26. We do not expect strong forward guidance from Powell, but see risks skewed towards modestly dovish market reaction post-Fed. So, Ryan, just from a trading perspective, how do you go into next week and the Fed meeting?
Yeah, I don't think there's any real positioning going in because, like Michael says, we're not going to get any big changes. Language, they're just going to tinker with little lines or little words because they've got to make it look like they're doing something. But otherwise, yeah, they're still not seeing the hard data. They're seeing this softer sentiment data, some of the private data weakening. They're still not seeing anything in the hard data. Jobs are holding up. So they've got no reason to talk the market in either direction. And again, as Michael said, they're facing exactly the same uncertainty over trade that everyone else is, although they may have to react in different ways depending on the outcome of that. Al's an absolute master of talking, either side of the fence. He's going to be talking big about the risks, talking about matters of the risk debate. But I think for traders, you've got to probably just keep your mind set on the longer term, which is the Fed will not want to keep rates up this high for an extended period of time, and that's becoming an extended period of time. So if we do get an end to all these tensions, geopolitical tensions, trade tensions, then you're probably going to get the market looking for the Fed to get rates down again. But on the flip side, if the US sees a big jump, because there's a lot of uncertainty at the moment, so firms, sitting on their hands a bit, if you do see a big jump in activity, that could actually bring some inflation with it, to which the Fed will then maybe have to respond, even, I'll go as far as saying, looking towards hikes. But I'm talking, maybe 6 months down the line. I'm not talking for next week.
Sure.
So back to
Have you hit here a bit early this Friday afternoon,
right? I wish.
Talking hikes.
Yeah, it's lined up in the fridge. But for next week, I'm expecting a pretty calm one, and Powell to walk that middle line, as he very well does, whilst obviously batting away the fact that he might get sacked or that Trump wants him to cut rates by 100 pips.
Yeah, I mean, there's more comments from Trump this morning, just saying he's told Powell to raise rates if there's inflation in 1 year. Oh, this was yesterday, I think.
He's not going to be there in a year.
That's great. But it's not that easy, is it? I mean, we all know that it takes time for any monetary policy to work its way through the system. And so just by turning the light switch on and off in terms of rate cut, it doesn't work like that, does it? So it's going to be interesting to see how he tries to square that one. Anyway, listen, we're coming to the end of our time in our look back on this current week. It's been an eventful one, and I, like you say, it's all about central banks next week, but we have this geopolitical story in the background to play out, and if Israel's true to its words, then we'll see more action from them, and it's really down to the response from Iran as to how markets interpret or deal with the outcome, I guess.
If I may, we've also got this G7 meeting this weekend where everyone's going to be scrabbling around to get trade deals, because everyone outside the G7 is apparently turning up. So more headline risk for us.
It's all going to take so much longer than people think to get over the line. A lot of these trade deals, and they're never quick in the first place. So disruption ahead, and more headlines, and I think more volatility for market participants to come, which is great for volatility and opportunity, I guess, as you both might agree.
Yeah, and great if you're a squawker as well.
Potentially, it might be a bit of news to put out there in the meantime. So if you're aware, or if you're not aware of who we are, livesquawk.com, take out a trial, see if it helps your trading day. To have a news service in your ear to let you know what's happening, it's no bad thing at the moment, I think. So, but I'd like to thank my two guests, Mike Brown from Pepperstone. Thank you very much.
No, thank you for having me, mate. Always a pleasure.
It's great insight from you. Ryan Littlestone, well, you add to the debate, I guess. So
you're just here to make the numbers up.
Well, yeah, I didn't want to say it like that, but Mike said it. But no, Ryan Littlestone, Forex Analytics, thank you very much for your trading perspective on everything as well.
I think it's a pleasure.
For your regular contributors, you must have some value to us at some point. So I'd like to thank you as well for helping us out with this and with the weekly review. So yeah, appreciate both your comments, and thanks again. And to everyone else listening, we'll have another one next week, another review next week, because I'm sure we'll have a lot to discuss then. So thank you very much.
Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.